Yesterday, Donald Trump signed an executive order imposing 25% tariffs on imports of steel and aluminium. Earlier, he alerted of slapping reciprocal tariffs on countries with higher tariffs on US goods. How are markets going to be reacting to all this? According to Transparency International, in their 2024 survey report just out this morning, corruption affects billions worldwide, destroying lives, undermining human rights, and exacerbating global crisis. Nigeria was ranked 140 out of 180, scoring 26 over 100, barely improving over the 2023 report, where it ranked 145 and scored 25 out of 100. Also, in part 2 of our analysis on global corruption, we consider recent Transparency International findings on $3.7 billion of corruption-linked African assets found hidden in wealthy nations. They're calling it a tip of the iceberg. Hello, this is Bode Oshosami on Global Business Insight, where we bring more depth to the main business headlines. The last time Trump hiked up tariffs on steel and aluminium was in March 2018. Then Trump imposed tariffs of 25% on steel and 10% on aluminium against most countries. If you look at the graph showing US inflation that year, inflation was 2.2% in February. That was just a month before the tariffs were introduced. Inched up to 2.4% in March. By June 2018, it was 2.9% when tariffs were extended to the EU, Canada, and Mexico, coming down to 2.2% by November. In 2019, it went down to 1.5% in February and stayed under 2% most of the year. Also in 2018, after the announcement, US imports of affected metals fell immediately. Brussels later responded to impose levies on about 2.8 billion euros worth of US imports, which covered a wider array of goods, including steel and aluminium, agricultural products, and other iconic US products often produced in Republican voting states, such as bourbon whiskey, Harley-Davidson, motorcycles, jeans, and the like. If we consider the recent experience with Canada and Mexico, it seems Trump is open to negotiations, but a promise to clamp down on fentanyl entering the US from China is not likely to be enough. Market analysts are not betting on a resolution. For example, Morgan Stanley analysts are writing that permanent tariffs on China could ramp up to 60% by the beginning of 2026. Looking at markets yesterday, we saw steel and aluminium stocks surge in pre-market trading after President Donald Trump's announcements. US traders are paying much higher prices for copper, aluminium, and steel as they rush to buy ahead of President Trump's tariffs. Cleveland Cliffs surged to close up 17.93%. Nucor jumped to close at 5.6%. Alcoa Core closed up 2.27%. US Steel was up 4.7%. Shrugging off tariff fears, we saw US stock markets also closing on a strong note. If you look at the CNN Investor Sentiment Index, it was neutral, moving up from fear towards greed, as markets seem to be betting this will end well. We, however, see safe haven demand, which shows the difference between Treasury bond and stock returns over the past 20 trading days, indicating a backdrop of nervousness. The safe haven dollar strengthened and gold is close to a record high. ThyssenKrupp, one of Europe's largest steelmakers, said it sees very little impact on its business, adding that Europe remains the primary market for steel, with only high-quality niche products exported to the United States, where it maintains a good market position. This week, Trump is also expected to announce tariffs reciprocal to what other countries levy on US imports. Countries have taken different approaches to tariffs, and some, like the US, have been lower than others to encourage free trade. That is about to change. The EU are also expecting tariffs and have warned that retaliation will be immediate and reciprocal. Markets are betting to see more big deals in an easier environment as analysts see the end of a regulatory environment that basically prohibited any kind of significant business combinations, even if it made strong economic sense for consumers and the industry. But things can go too far, as Trump is said to have instructed Attorney General Pam Bondi to prepare new, more relaxed guidelines for Foreign Corrupt Practices Act enforcement. Heavy borrowers from the World Bank can also expect higher costs as credit rating agency Moody's warns that the AAA ratings of the World Bank and other top multilateral lenders is at risk if the US withdraws financial support. Finally, looking at US markets, when you consider more recent signs of weaknesses in the latest big tech performance and outlook, we also will get NVIDIA later in the month. That's their performance. And you also look at the sudden plunge of NASDAQ after DeepSeek launched its cost-efficient AI model, and tech giants are still piling heavy capex spend on artificial intelligence with cloudy clarity on returns. The big bet seems to be that deregulation and the market-friendly White House will do the magic. But we have seen this before. Too much greed, too much liquidity, and sudden surge in risk-taking with hyper-relaxed regulation can easily become problematic. Now, with optimism causing almost everything to rally, irrespective of context, it has to be time to be wary. If Fed Chair Jerome Powell is using the terms gradual and careful to describe their posture, the prudent investor needs to be equally cautious and well prepared for all scenarios, especially the worst case. In this second part of reported analysis on corruption by Transparency International, as it releases its 2024 survey, Transparency International research revealed a staggering network of companies, properties, bank accounts, and luxury goods, a total of about 400 assets worth at least $3.7 billion spread across 74 jurisdictions, adding that this figure is the tip of the iceberg as it only includes assets identifiable through public sources. The real figure could be 10 times more. About 80% of assets were held abroad, often far from where the corruption originally occurred, with companies in the British Virgin Islands, Panama, and Seychelles emerging as top incorporation hubs for anonymous companies used to conceal assets and stolen funds. For hiding real estate, France, the United Kingdom, the UAE, and the United States were the preferred locations for purchasing properties connected to suspicious activities, while Transparency International says for bank accounts, the preferred destinations were Hong Kong, Switzerland, the UK, the UAE, and the US, often used as destinations for bank accounts used to pay bribes, move, or store dirty funds. For instance, Swiss regulators reported in 2023 that 50% of banks inspected had largely unsatisfactory anti-money laundering systems. Companies and trusts with obscured and difficult to access ownership were used to distance corrupt individuals and their dirty funds from the asset in question. The analysis by Transparency International also showed that popular destinations like France, the UK, and the US stand out, among other things, due to many regulatory loopholes that permit hidden ownership of real estate. The world is dealing with a lot of issues. Headlines are focused on the struggles of the Magnificent Seven tech firms, geopolitical crisis in Ukraine, the Middle East, Trump 2.0, DEI, DOGE, that's the Department of Government Efficiency in the US, deglobalization, trade recalibration, trade tariffs, climate change, extreme weather, wildfires, stabilization of economies post-COVID, economic stagnation in Europe, tepid global growth, and the rising China. Very, very few are paying any attention to what I think is perhaps the greatest economic tragedy unfolding before our very eyes: the unjust draining of resources of developing economies through corruption that is damaging billions of vulnerable lives. Little attention is paid to corruption in Africa and poorer states, perhaps because the main beneficiaries are the real estate and booming financial markets of the West. As institutions and regulations are weakened in the US, and Europe and UK are more conscious of the need to revive their sagging economy, we can expect even less focus on corruption in Africa and illicit capital outflows from the continent. Now to more business news. Fed Chair Jerome Powell testifies today on the economic outlook and monetary policy actions he's taken before the Joint Economic Committee in Washington, D.C. We also get U.S. January inflation, that's CPI, out tomorrow. The U.S. Department of Government Efficiency, which was established by Trump last month, has asked the government agency to significantly reduce the government's office space footprint, potentially flooding the commercial real estate market with older, less desirable buildings. Fourth quarter earnings at McDonald's fell short of analysts' estimates, but strength in total same-store sales lifted the fast food chain's stock. Analysts are surprised with the unexpected growth in global sales, aided by demand for affordable burgers and fries among diners in the Middle East, Japan, and China. Shares of the burger chain closed up 4.8% despite a bigger than expected drop in the US sales due to an E. coli outbreak linked to McDonald's quarter pounder hamburgers that was in late October and cautious spending. In South Africa, the presidency is finalizing names of international envoys to be dispatched to various countries as battle lines deepen between South Africa and the new Trump administration. The envoys will be responsible for clarifying SA's foreign and domestic policies after a series of false assertions of widespread land grabs under SA's expropriation bill. This is leading to fears that SA's relationship with one of its largest trade partners could deteriorate. Nigeria's manufacturing sector recorded a poor business performance in January 2025, according to the Business Confidence Monitor report compiled by the Nigeria Economic Summit Group and Stanbic IBTC. The manufacturing sector scored minus 0.66 on the Confidence Monitor Index for January 2025, still a notable recovery from December 2024 score, which was minus 2.43. The Central Bank of Nigeria has announced a new date for the 299th meeting of the Monetary Policy Committee, shifting it from the initially scheduled February 17 and 18, 2025 to February 18 and 19, 2025. Speculation surrounding the meeting date had earlier emerged due to delays by the National Bureau of Statistics in releasing the rebased Consumer Price Index. Since April 2024, the NBS has been actively engaging stakeholders as part of the GDP and CPI rebasing processes. OpenAI CEO Sam Altman yesterday rejected a $97 billion purchase bid by Elon Musk, who says he wants to return OpenAI to its original vision to be a not-for-profit research organization. Musk owns a startup, XAI, which is a direct competitor to OpenAI. OpenAI seems to be transitioning under Altman's leadership to a for-profit outfit. Asia-Pacific markets traded mixed as investors assessed US President Trump's tariff campaign. Having had a lot of time to price in the impact of tariff-related turmoil, global markets are apparently unfazed by latest tariff threats. Oil prices recovered after the third straight week of losses, focused more on tightened supply and geopolitics, despite risk aversion associated with the possibility of a trade war and the dampening effect on global economic growth and energy demand. Well, that's all we can take on this episode of Global Business Insights. You can watch us on BusinessDay TV YouTube channel Monday to Friday at 11 a.m. West Africa time.